Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. I want to get to our next guest, Jennifer Lee. She's a senior economist, managing director at BMO Capital Markets. Jennifer, lots of economic data this week, and likely will have an effect on what we hear from our Federal Reserve in the coming months. What are you looking at this week in terms of the eco data?
Good morning, everyone. Thanks for having me on. Sorry, I'm still laughing about the bike to nowhere. That's how I feel sometimes with the treadmill. So for this week, I think all the key numbers are coming out tomorrow, although this morning's reports on GDP was a little bit kind of interesting. Even though we saw that downward revision, it was all due to inventories and net trade. But I noticed that the consumer spending portion was still a little bit, just a smidge higher, which is kind of interesting. But tomorrow's PCE numbers will definitely be key because it's going to show you how Q3 is beginning.
That's interesting too, because this is a revision to that, and you are seeing consumer spending revised higher there. And those expectations, when I look at the ECFC function in the Bloomberg terminal that takes sort of the estimates for the average, what economists are expecting, you don't see even a quarterly contraction anymore coming up for the next few quarters. So when you do have so many economists expecting that potentially we could see a recession in the next few quarters, how do you square that away when you have data like this that's being revised to the upside?
So we are actually, it was interesting because when you look at the components, it was all durables that actually was revised lower. But again, it was upward revisions to services, and that's where all the demand has been. But we actually have a contraction for the first quarter. I had to look at my notes here. For the first quarter, actually, in around the turn of the year, because we are still looking for growth to slow overall. We're not looking for that hard landing that many were calling for, just a number of months ago. We're still looking for that soft landing, and so far all the data are pointing in that direction. Things are slowing, which is not a bad thing. This is what the Fed wants. This is what they really, really want. I think in terms of the consumer, just to have them pulling back a little bit and eventually just taking all the spending off the table at some point early in the new year will help, again, growth slow even further, but not have that hard landing.
So if there is not a hard landing here, how do you think the Federal Reserve will kind of interpret some of this data? They could very well pat themselves on the back, take a little bit of a victory lap, and just kind of stand pat for a while. Is that something you foresee, or do you feel like they may feel like they have more work to do in terms of pushing rates up a little bit?
It's all going to depend. I mean, it sounds wishy-washy, but that's, unfortunately, that is the case. Everything is data dependent. I don't know if they're going to be doing victory laps. I'm just judging from what Fed Chair Powell said last week. In Wyoming, I don't think they're doing any victory laps. They're still watching everything very carefully. He did, give a nod to the better inflation data of late, but he said it's just far too soon, and we already knew that. I mean, a couple of months of better inflation data are definitely not enough to have them be very, very comfortable. I think they need a lot more than that. But for sure, our official call is still that they are going to stay the course and keep watching the data and not do anything. And of course, there is a risk. I still think that the risk is to raise rates if things do not cool or cool more than they want or less than they want. You know what I'm trying to say. Of course, all the latest jobs data have been very interesting as well with the ADP this morning. I don't take too much stock in it because it's sometimes quite wonky compared to what the official data say. But overall, we have seen that slowing in growth, in job growth, in job demand, lower job openings out there, or fewer job openings out there. Still far more than the number of unemployed Americans out there. So it's still tight, but at least we're all heading in that right direction.
We talk so much about whether or not we'll see the Fed potentially raise at least one more time here. But what about just how long that they keep rates at an elevated level there? And how long are you expecting that to potentially happen?
So we are looking officially for the first rate cut to come probably sometime in the middle of 2024. So mid-year, so another year from now. We've actually been pushing that out a little bit more just because the data have shown that the U.S. economy is a lot more resilient than anyone would have hoped for at this point or expected. So if anything, they're going to keep rates for higher for longer. So I don't think, again, we're not going to see another rate cut or a rate cut coming until at the earliest middle of next year.
We're going to get, obviously, on Friday, the change in non-farm payrolls. Consensus is for a gain of 170,000. That would be down from prior period of 187,000. But unemployment rate kind of sticking around 3.5%. Where do you think that unemployment rate goes? I have no idea how this labor economy is working. We had the JOLTS number come down yesterday, but where do you think the unemployment rate ultimately goes?
Higher. If you had to pick a direction, it'll be higher, but not too much higher. Probably something in the mid fours, I believe we have. This is all to be expected at some point. Like when you have over 500 basis points of rate hikes coming from the Federal Reserve in such a short amount of time, at some point, again, we're already seeing that job growth slowing. The demand for jobs are also starting to wane a little bit. So we're going to start seeing that unemployment rate inch a little bit higher, but it's not going to be ratcheting higher. And at the same time, there's still demand out there for certain categories of workers. Maybe not, on a broader scale, but certain areas like construction, we're still lacking. Even on the technology side, I'm hearing stories about, like shortage of engineers, for example, and not enough. Even though we've got all this money coming in on the fiscal side to build all these facilities to create semiconductors, we don't have enough people who are trained to build for that certain particular technology. So certain pockets are still going to be a lot more demand, but broadly speaking, just because of slower growth, because of higher interest rates, we're going to start seeing that jobless rate inch a little bit higher.
Well, across this pond, we do have the ECB having a meeting on September 14th that is ahead of the Federal Reserve's decision on September 20th, but we are going to get some Eurozone inflation numbers on Thursday. How do you square away the issues when it comes to the inflation that Christine Lagarde is clearly trying to fight and indicated that at Jackson Hole last week versus what Fed Chair Jerome Powell is trying to do in the United States?
It's funny that you're mentioning the ECB because if for the ECB, it's almost like a coin toss right now. If anything, right now, my official view is still that they're going to stay the course, just given that inflation has come down from those highs, given that all the hawks or most of the hawks have started to tone down their hawkishness, and the fact that China is slowing considerably as well. So I think that might be enough to put allow the ECB to sort of step aside a little bit. And she sort of hinted at that July meeting. However, the fact that inflation is still sticky. We got 3 new pieces of data overnight. Belgium, for example, it was like all over the map. Belgium CPI was relatively steady. German CPI edged a little bit lower, which is key, but it wasn't as low as consensus had expected. And in Spain, inflation rose for the second month in a row. So it's going to show that I don't think we're going to get a very clear signal from tomorrow's inflation report. And I think that will put the ECB still at play for September.
Well, most importantly, how are things in Canada?
Things are slowing. It's actually slowing a little bit more than we had, a little bit more actually than what's happening in the U.S. We're going to get some key data this week. On Friday, we're finally going to release our real GDP numbers for the second quarter, and we're looking for growth to slow to about a 1.2% annualized pace, which is about half of what we saw in Q1. We had a strong start to the year, but we've been dealing with a lot of wildfires, almost coast to coast. Labor strikes and all that's going to weigh on the second quarter. Of course, higher interest rates, and consumers here are a lot more susceptible, I guess, to rates than they are in the U.S. So I think we are going to see slower growth. It's just something, by the way, that the Bank of Canada is going to very much welcome because inflation is still too sticky. So as long as inflation or the economy continues to slow, which we're expecting in the second quarter, that will allow the Bank of Canada to stay also on hold for the rest of the year.
All right, Jennifer, thanks so much. We appreciate getting the global view, including our good friends to Northern Canada. Jennifer Lee, Senior Economist and Managing Director at BMO Capital Markets. That is Bank of Montreal.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
We did get a few different data points on the housing side today. So we were just talking about earlier the pending home sales unexpectedly rising for a second month, but also we did see that mortgage applications also rose in the latest week. So I want to get straight to our next guest, Odeta Kushi, Deputy Chief Economist at First American, who's joining us on Zoom to discuss the latest data in the housing market. Thanks so much for joining us. Walk us through these latest data points and what this really tells us about the housing market at this point, because we do know that mortgage rates are at about a 2-decade high at this point.
That's right. So the recent increase in pending home sales, this is the second month in a row that there's been a modest increase in pending home sales, which is a leading indicator of future sales. That's really a testament to the strength of the demand side of the equation. There's still quite a bit of pent-up demand for homes, but insufficient supply to meet that demand. So some cautious optimism in the latest numbers. We saw this morning a weekly increase in purchase mortgage applications, although again, a very modest increase on a year-over-year basis. We're still quite low, both for mortgage applications and pending home sales, but you really see the strength of demand, even in such a high interest rate environment and such a low inventory environment.
What is the catalyst? Because typically the springtime is more of the boom there when you do see that when it comes to home sales, but this is a little bit later than that. Why is that?
Well, the pent-up demand, there's been a lot of multiple offer situations. And so, the folks that are losing out on those multiple offer situations are on the sidelines, ready to jump in when there is sort of a house out there that meets their needs and what they're looking for. And so maybe a little break from seasonality there.
So Odeta, I'm looking at the bank rate 30-year fixed mortgage, 7.53%. Is there a level where that needs to decline, where that might free up sellers to maybe say, all right, I can in fact part with my lower rate mortgage and maybe put my home on the market? Is there a break-even number out there that you think might be the magic number?
Well, that's the big question. Right now, more than 90% of existing homeowners are locked into rates below 6%. So certainly we'd need to see something below 7% to even see some movement there. There's not a lot of financial incentive for existing homeowners to drop those record low mortgage rates that they locked into at this point. So I think, well under 7%, probably below 6% to unlock some of that inventory.
We did see July pending sales rise the most in the West and also actually increase in the South, but probably not surprisingly, they did fall in the Northeast. What kind of dynamics are you seeing from a regional perspective at this point?
So the West that's your traditionally more expensive markets. And those are also the markets where we've seen the most severe price declines from the peak. And so in a higher mortgage rate environment, something needs to give. And in this instance, it has to be price. So the areas where we're seeing price adjust to the reality of higher mortgage rates, they're seeing a little bit more activity. So in this instance, it would be the West Coast, those traditionally more expensive markets.
So, Odeta, if there really aren't a lot of existing home sales in the market or available on the market, are the builders making up any of that kind of shortfall by just building more houses, new houses?
That's right. Builders are picking up market share. Traditionally, existing home inventory makes up about 90% of total inventory. These days, it's more like 70. Okay. So builders have really stepped up to build more homes. They're also offering incentives, rate buy downs, price declines to sort of help and entice buyers into the new home market.
Which builders have been kind of setting themselves apart the most in this, and which ones do you think are struggling more, depending on, I guess, which type of demographic you're trying to cater to?
It's really the bigger builders that have had a little bit more power to be able to do these rate buy downs. So I think in this market, it's more advantageous to be one of the big builders rather than the small builders that maybe don't have the ability to offer some of these incentives.
Odeta, one of the things that, I hear from the home builders is, when they talk about their costs, and I don't even think about it, but that's the biggest cost, I guess, is just land. And some of these markets, everybody's flocking to Texas and Florida and places like that. Where do they get land, and can they get it on an affordable basis?
Lands, it's really multiple supply side headwinds and higher costs for builders. The cost of land certainly is higher, but of course they also are grappling with ongoing supply chain headwinds, right? Those aren't totally gone. And of course, the price of labor has gone up. Wages in the construction industry have gone up as well. And so costs all around for builders have gone up. And that's made it very difficult for them to build at that sort of starter home price tier, that entry level price tier. And that's the level that we need at this point, because it's a lot of first-time home buyers out there that have been priced out of this market, and they're looking for that starter home price tier, and builders just aren't able to build at that price point because of higher costs.
So how do we end up fixing the inventory issue that clearly got exacerbated during the pandemic, but that was already an issue even coming out of the housing crisis?
There is some mitigating factors here on the existing home side. Of course, if rates fall, that will help to boost the market a bit. But we also have 42% of existing homeowners who don't have a mortgage on their home. They're free and clear on their home, and so they're sitting on a ton of equity. And so a lot of those homeowners can sort of be a mitigating factor amidst this rate lock-in period. They aren't financially disincentivized by higher mortgage rates because they don't have a mortgage. And so there's that aspect on the existing home side. On the new home side, we just need builders to continue to build more homes. And they do have quite a few challenges, whether it be regulatory challenges. And so anything that can be done to sort of ease some of those challenges for builders to allow them to build more homes where people are looking to buy.
How much of a concern is it for you when they can't potentially offer some of those price points to maybe younger buyers at this point?
Then we see that happening quite a bit. There's a lot of buyers that are now priced out of the existing home market. And of course, the new home market is traditionally been more expensive. It's been more expensive to buy a new home rather than an existing home on average. So a lot of those buyers are still on the sidelines and waiting for rates to come down, or they're looking at a lower price point home if they can find it in their market.
Also, what if people aren't willing to move out of their house if they already locked in, say, like a 2% mortgage rate? Or obviously we had rates at historic lows, which translated into mortgage rates. But what do you do with that dynamic if people aren't willing to move? And then obviously you would have home builders that need to build homes.
That's exactly the issue that we're facing in today's market. Existing home sales have been so depressed, mostly because an existing homeowner doesn't want to let go of that home. And that's likely a dynamic that we'll continue to see play out in the housing market over the next several years. I don't anticipate rates to go below 3% again. And so I think that will be constraining on the housing market for some time.
All right, so let's say I do the math, Odeta, and I can afford to pay a 7 handle on my mortgage. I go into a mortgage lender. Am I going to get that loan?
So credit standards have eased a bit since earlier this year. Certainly, credit availability has been generally low, but it will really depend on your borrower characteristics, right? On what kind of borrower that you are from the perspective of the lender. But they have eased a bit.
I think I'm a good credit. Would you loan to me?
I would.
Yeah, I figured I wouldn't. Like certain people in this room, I might not, but we'll have to see. Odeta Kushi, thank you so much for joining us. Odeta Kushi is the Deputy Chief Economist for First American. First American is a financial company. They provide title, settlement, and risk solutions for the real estate transactions. So they kind of get to see the whole space there.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Welcome now, our Bloomberg TV and radio audience. We are joined now by Michael Sonnenshein, a Grayscale CEO, and Bloomberg's Sonali Basak also joining us as well. Michael, it's a real pleasure. This was a big day for you yesterday. What happens now after the U.S. court sort of gave you some runway to be able to launch a spot Bitcoin ETF? What do you do now?
Yeah, so thank you so much for having me. Let's be clear about yesterday. So yesterday was the culmination of more than a year worth of litigation. The SEC denied GBTC's conversion to an ETF. We immediately filed a lawsuit. 14 months later now, we finally got a decision from the DC Circuit, and a panel of 3 judges unanimously voted and agreed with Grayscale, and that actually vacates the SEC denial order. Huge win for Grayscale, huge win for our investors, and really the crypto and investment community as a whole.
But there's a process here to the point that you're making, and there is a chance that the SEC looks to broaden this out, potentially fight the decision, bring this in front of a larger array of judges. And so if you're thinking about that potential process ahead, do you have any concerns that the race to bring an ETF to the market will leave you behind?
Well, so today is day 1 of a 45-day period during which the SEC has the ability to request a rehearing. Ultimately, at the end of that 45-day process, you could expect a final mandate from the court with operational next steps. Now, of course, in the interim, Our attorneys are going to be working proactively with the SEC to try and make this conversion as expeditious as possible. But we really do need to ensure during this period we're adhering to the federal rules of the appellate court.
Do you need to refile for an ETF? And if you do need to refile or amend, are there certain things that you would add, such as a surveillance sharing agreement? Do you worry that the ones that already have one have a competitive advantage to your filing?
Well, so the operational next steps on anything that Grayscale will or won't have to do will be contained in that final mandate that comes out of the court. But one of the interesting things that we actually got from the court in yesterday's decision was that the court agreed with us that the arguments we've been putting forward all along throughout this process are such that the SEC already has the tools it needs to approve spot Bitcoin products like GBTC, that there is sufficient surveillance between the CME, where Bitcoin futures trade, and national securities exchanges like the New York Stock Exchange, where we intend to list GBTC as an ETF. So there really shouldn't be any further grounds like the SEC has been relying on to continue denying these types of products from coming to market.
Michael, you're very optimistic. Danny here, by the way, in London. Great to speak with you. It makes complete sense that you're optimistic and in a good mood. But do you have a nagging voice at the back of your head that something might go wrong? What are you most afraid of that could kind of undo some of the progress that we saw in yesterday's decision?
Well, I think we're really at a pivotal moment here for crypto. Certainly, a lot of investors have been voicing to us increased optimism both around the recent Ripple victory, now obviously the Grayscale victory in court yesterday, as well as what they're seeing taking place in Washington, right? You now have draft legislation that's passing through Congress, and we're really optimistic that there will be greater regulatory clarity for investors through some of these types of actions. And I think if we take an even larger step back and look at the broader landscape, crypto has been one of the best performing assets year to date. And coming out of this most recent crypto winter, what we're hearing and what we're experiencing is that investors know that crypto as an asset class is most certainly here to stay.
Can we just go back to refiling for a second?
Sure.
So do you have to refile?
We will have to see upon the final operational procedures that come through that final mandate that the court will issue.
So you don't know, but you may.
We don't know what the final opinion will say until we reach the end of that period, correct?
Is there, I've been reading stuff from yesterday too, that you may have won this battle, but then lose the war, and that there's a bunch of other competitors now. So now You're not going to be the only horse in town.
Yes. So this is a topic we've talked about before, ladies. It's really a world in which there are multiple spot products is a world that Grayscale has long been ready for. There are multiple Bitcoin futures products. We believe that there will be a world in which there are multiple spot Bitcoin products. That being said, we want investors to have choice. And some of the things that we do think investors will look to when they are making those allocation decisions are the size of the fund, the liquidity of the fund, the track record of the fund, right? Let's not forget that GBTC is the largest Bitcoin fund in the world. It's owned by millions and millions of investors. It has 3+% of the outstanding Bitcoin supply, and really now has almost a 10-year track record of operational success, right? Whereas a lot of the other products coming to market are really making use of GBTC's operations, disclosures, reporting, and GBTC is really paving the way to broaden out that market.
There's another massive market question here, and it's not just about the pace and time, it's about the structure and the fees. Because if you look at BlackRock, Invesco, Fidelity, these are asset managers with a history of coming in low. And if you look at the fees that you have offered, and really has made a very profitable entity for Digital Currency Group and Grayscale, how much lower exactly can fees get for the Grayscale product in the form of an ETF?
Well, what I've committed to historically, and will say again to you today, is we are committed to lowering fees when GBTC converts to an ETF. We'll obviously have to come back on and talk to you about what the fees are when that conversion actually happens.
So the other strangeness here is the discount that the GBTC is currently trading at. You had gone from 24 yesterday to 15 below net asset value, back to 20. Can you answer to this market volatility here and the uncertainty that investors are grappling with as you head towards this process?
Well, there's a couple of things in that dynamic. So number one, there certainly was increased trading volume yesterday in GBTC, a lot of excitement and enthusiasm based on the victory that GBTC shareholders had in the court yesterday. Now, as we eventually approach an ETF, you'd expect that eventually there will be an arbitrage mechanism through the ETF that will allow for any premiums or discounts to be eliminated. That's a really, really important function of why ETFs serve in the capacity that they do. And it's really the core of what we've been fighting for throughout this entire lawsuit, right, is to ensure that the optimal investment structure is there for investors, and we do eliminate any premiums or discounts.
Michael, have you heard anything from the SEC over the past 24 hours? Any updated communications or questions?
We have not heard anything from the SEC, only just from public reporting. We've seen certainly that the SEC is reviewing the decision, much the same way my team and my legal team is reviewing the decision as well. And again, it is our intention to continue to have a proactive and constructive dialogue with the SEC during this 45-day period.
I guess the other question becomes, why here versus if crypto and Bitcoin is going to become a hotter topic overseas, right? Why launch here? Why not go somewhere else and launch?
Well, this is the center of the financial markets and capital formation.
Yeah, but clearly the U.S. government does not like crypto.
Well, you know, from my standpoint, Grayscale, now coming up on 10 years of operational history, you know, we purposely decided to set up shop in the U.S., make use of existing rules and regulations, and it's our intention to continue to do so, right? Enabling investors to access this innovative asset class, but in a way that feels traditional, familiar, and again, within those regulatory, constraints that they're often used to.
We were talking about the potential to either refile or amend. We were talking about the SEC's frustrations with crypto and fight against a lot of the parts of the crypto industry. Are you specifically addressing some of the SEC's concerns when it comes to their concerns around market manipulation, investor protection around retail investors? And are there any changes that need to be made before you head into a new relationship with them?
Well, I think we always have and will continue to serve in a capacity that's educational with the SEC. This is an asset class that continues to evolve very rapidly, and we feel a tremendous responsibility to be serving in that capacity. Specifically, though, Sonali, to manipulation, fraud, things of that nature, if you look closely at yesterday's opinion that the court issued, the court agreed with us that the SEC did not come up with substantive reasoning as to how to explain the difference between futures and spot, and the fact that these mechanisms that we believe are already in place to detect things like fraud and manipulation in the Bitcoin market are already present.
Michael, you mentioned earlier in this conversation that you had some hope that Congress would take action when it comes to regulation. Perhaps there's more appetite for them to approve and to welcome such products. You said you haven't heard from the SEC. Have you heard from Congress? What sort of noise are you hearing around Capitol Hill?
So we are certainly very engaged with both sides of the aisle in DC. There is no question now that crypto has become actually a nonpartisan issue, right? We're realizing that so many of our legislators recognize that their underlying constituents are involved in crypto, are increasingly going to be involved in crypto, and they want to ensure that they're approaching legislation in an appropriate way that protects their underlying constituents. I am optimistic that this upcoming, Congress can actually move some legislation forward. And again, I do think it's really a pivotal time for us and other stalwarts within the crypto space to be educating our politicians about crypto so that they actually are looking at legislation through a very, knowledgeable lens.
I'm going to push you just one more time on the fees here, Michael.
Oh, of course you are, Sonali.
Well, the reason being is this is a matter of competitiveness when we come to this market. It is also going to determine how much retail investors are going to really pay for a product that has been more expensive than other ETFs in the past. Give us a roadmap here on how you're thinking about it, because you've had years to think about it.
We have, and when GBTC converts to an ETF, we will lower the fee. You said that it's been more expensive than other ETFs. Notably, GBTC is not an ETF today, right? And so when GBTC converts to an ETF and it becomes in that product structure and it perhaps is in an environment with other competing products, there are going to be other factors for us to consider there as well.
All right, that was Grayscale CEO Michael Sonnenshein sitting down with our own Donnie Berger, Sonali Basak, and Alex Steele here at Bloomberg's HQ after a U.S. court ruled in favor of the digital currency asset manager. And let's get some more color on this because it is being hailed as a very important day in the world of crypto here. James Seyffart, he does this stuff for a living, ETF Research Analyst at Bloomberg Intelligence. James, summarize for our listeners and our viewers here what the court ruled yesterday and why it's important to our good friends at in the crypto space.
Yeah, so Sonnenshein just did a pretty good job of explaining what happened there. But at the end of the day, it was a complete and utter rebuke of all of the SEC's arguments for denying spot Bitcoin ETFs in the past. Now, specifically, it was in favor of Grayscale's arguments. Basically, they went and they filed this lawsuit against the SEC and the DC Court of Appeals, and they were saying that this is a violation of the Administrative Procedures Act, which, to get wonky, just means you have to treat like situations alike. A regulator can't look at one thing that's extremely similar and come up with a different answer. And what this ruling said is Bitcoin futures ETFs are not substantially different from spot Bitcoin ETF, which anyone who's been in financial markets knows that futures markets are completely intertwined with the underlying spot markets of whatever they track. There's a 99.9% correlation here. Basically, what the judges in this instance said is the SEC did not do a good job at all of arguing why they approved futures ETFs and still denied spot Bitcoin ETFs.
So really, it doesn't mean that Grayscale's Bitcoin Trust would immediately be converting to an ETF. It's like you said, it means that the SEC did fail to explain why it approved Bitcoin futures exchange-traded products, but just not Grayscale's proposed products. So what does that mean next?
Yeah, so I mean, it's a complicated question because one, we don't fully know what it means next. I've read a bunch of these court decisions and opinions in the past to kind of understand, and in many cases, the court will give some sort of deadline before XYZ happens, or they need to do this and what have you, and they kind of didn't do that here. So they have 45 days the SEC has 45 days to go with an en banc hearing, which basically just means this is a panel of 3 judges decided this case. An en banc hearing, what you request to get one of those would be with all the judges on the court. In this case, I think it's 17 judges. So basically, rather than just 3, it would be 17. But this was a unanimous decision, right? So 3 judges all agreed, and the language was very strong, rebuking everything that the SEC said. So what next is, I'm not really sure, right? So the SEC, what they did is they vacated the SEC's order denying Grayscale's application to convert GBTC into an ETF. This isn't an approval letter that GBTC can now be an ETF. It's just your reasoning and why you denied this just isn't good enough, and you didn't do at all what you were supposed to do in issuing this order. So what comes next is basically trying to figure out, what's the SEC going to do? Are they going to come back and issue another denial order and basically say, come up with different reasons? Or are they just going to come back and approve it? We also don't have timelines. Is Grayscale going to have to just go through this whole 240-day process again and refile? Is there going to be some other 45, 60-day deadline where the SEC is going to review this and then issue a statement? We really don't know.
Explain to me, at least, why an ETF on spot Bitcoin is better than one that's based on futures. Why is the spot market better?
Yeah, so spot ETFs in general are just the holy grail, right? I mean, the ETF wrapper, it's a technology, it makes everything very easy. You can look at gold ETFs as a perfect example. But the reason that spot is better is because in futures contracts, one, they're derivatives. So a lot of people don't understand exactly what futures contracts are. And futures contracts, they expire every month. So you need to roll these contracts. So basically what you're doing is you're buying this thing. Say you buy the September contract. Then at the end of September, you have to sell that contract and buy the October contract. And it's called rolling your futures. And if the futures market is in contango, which basically means when you're selling your ETF, when you're selling your futures, if you have to sell that September futures contract, and when you buy October, the October contract is more expensive, you're losing out at a cost because you're selling low and buying high. So there's additional costs in constantly rolling these futures. Now those costs can go in reverse, but all it really means is it's not necessarily going to track the exact price of spot Bitcoin over a really long term period. So over short term, for traders who want a couple days exposure, maybe even a couple weeks exposure, these futures ETFs are very good at giving exposure to Bitcoin. But for buy and hold investors who want to hold this for a long term or hold this for years or what have you, the spot market is just so much better. And this is exemplified in 2023. So right now, futures ETFs like BITO, the largest one in the US, is trailing spot Bitcoin by 8% this year. Going back to 2021, before Bitcoin futures ETFs were even approved, I mean, those numbers go up to 50, 60% over a 1-year time period. Now, the futures market has gotten more efficient, and that's unlikely to happen again. But you're still, like I said, year to date, you're trailing spot by 8%, which that's a cost. That's a big cost that you're taking on if you're investing in these Bitcoin futures ETFs.
We only have about a minute left, but the SEC is set to issue initial orders Friday on at least 6 Bitcoin ETF applications. What are you expecting to happen?
Yeah, so we actually just published a note this morning talking about this case and those applications. My base case is that those are going to be delayed. So the way this process works is there's a whole bunch of deadlines 45 days, 45 days, 90 days, 60 days. And until the last one, they can just choose to delay rather than approve or deny. When they get to the last one, you have to approve or deny. All these deadlines coming up on Friday, they can opt to delay, and it's very easy to do. I just think the SEC, I mean, it's not out of the complete realm of possibility that they just go ahead and approve these things. It might be a nice little pushback against Grayscale for winning this court case, but theoretically, Grayscale would then be able to launch GBTC as an ETF very quickly after. But we're expecting delay on those orders, so we don't expect anything because the SEC is likely trying to get things in order. As Sonnenshein said in his interview, they haven't heard anything from the SEC. There's just been a public statement that they are reviewing the opinion from the DC Circuit. So I think the SEC is basically just getting their ducks in a row, and they're just going to basically punt on this next deadline, which is what they've done historically with these deadlines.
All right, James, excellent stuff. As always, you kind of laid it out there for us. Big day for the crypto space. James Seyffart, ETF Research Analyst for Bloomberg Intelligence down there in our Princeton campus.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Let's talk about these markets. Let's do it with someone who does this stuff for a living. Ron Sanchez, he's the EVP and CIO at Fiduciary Trust International, joining us live in our Bloomberg Interactive Broker Studio. Thanks for making it in, Ron. What do you make of this market? Again, some folks on the street, Scott Cronin City says some people may be playing catch-up for the remainder of the year, and that might push markets a little bit higher. How are you guys thinking about these markets?
So markets have been tricky this year, and I think there has been some catch-up. Our view has been the entire year is that we do believe in the soft landing. I think those that have been looking for a recession will continue to wait.
Okay.
One has not materialized, and our expectations is one will not for the balance of the year into 24. So we think from a market perspective, we saw a lot of people jump into this market, embrace the soft landing in July. Again, market returns for the year to date have been obviously quite surprising and quite favorable, but I do think they reflect a well-entrenched or embedded soft landing that is now a consensus.
So how do you advise clients to position in this type of environment?
So again, after the sort of the market return here, it gets a little tricky. As I said earlier, I do believe that our expectations are that it's a soft landing, and I think that is in price. And so I think from an expectation standpoint, you want to sort of be patient here. I do expect sort of choppy markets or range bound. I think that range bound not only relates to the S&P 500, but also fixed income as well. And I think we're looking at sort of an incremental return profile for the balance of the year, but we should hold our gains. So again, sort of a reasonably neutral view.
Are your clients typically more longer-term investors?
They are indeed. Yeah, really long-term.
So you're not going to be making changes on a short-term basis.
We would not be sort of uber tactical here and sort of outguess ourselves. Markets are reasonably priced here, and again, in the absence of a sharp contraction in economic activity, we would stay invested.
So where are you in terms of your allocation? I don't know, the equities, fixed income, I don't know what else you throw in there, alternatives. Kind of where's your allocation today? Maybe how's that different from normal time or other times?
So from a global perspective, we are neutral to the U.S. and underweight international. Again, I think from sort of the U.S. is the outlier here with the strongest growth pattern by far. There are challenges, as we all know, in emerging markets, specifically the largest one in China. And Europe is going to be sort of challenged as well. They've had a great return profile sort of earlier in the year here, but our expectations, that's pretty slow growth in that environment. So again, we're neutral U.S., slight underweight outside of the U.S., and within fixed income, we are neutral, and with sort of an eye towards finding fixed income here reasonably attractive and looking to potentially extend duration.
Well, so I can go to the 2-year, and a couple of days ago I could get 5% in a 2-year Treasury. Why don't you just go there and then go head out to the beach?
Or money market funds, right?
Money market funds, yeah.
So that is one of the most interesting sort of dynamics for a strategist with clients saying, boy, for the first time, cash is king. I can get north of 5% on a 2-year note or a money market. But again, from an equity standpoint, the S&P is up double-digit returns, and so need to be real careful about the allure of cash. It's nice to have reserves. It's nice to be in the front end of the curve. But again, at some point in time, as the economy does moderate here into 24, the return profile for sort of that short intermediate, meaning 4 and 5 year, is going to be more appealing from a total rate of return standpoint. But right now, 5 is certainly doesn't hurt.
What do you think the catalyst would be to move that money from, say, money market funds back into stocks?
So I think you saw a little bit of that in July. Again, the allure of a risk-free rate of 5, I think, has pulled a lot of money to the sidelines, and I think sort of the soft landing has pulled people in. Those that have been forecasting a recession have sort of come in. I think that really was the pop in July, but there's plenty of dry powder here, and that's why I think it's sort of difficult to become sort of bearish in this environment, both for fixed income and equity. You
said you were neutral on the U.S. for equities, correct?
That's right.
So what takes you to move it even higher for another rating on that?
So valuations are definitely on the upper end. The risk premia has compressed as equity markets have come down a little bit, and fixed income has gone to 4.25 on a 10-year. The compensation for equity is not overly compelling from a historical standpoint. I think for us to be a little more confident about the return profile going forward is a little more confidence that the economy is in a soft landing more definitively, and or higher conviction, and that earnings are bottoming. So more of the micro. Once earnings have bottomed, I think we'll look a little more favorably.
I'm looking at the Bloomberg Index browser, INGO, on the Bloomberg terminal, and boy, in the U.S. corporate high yield space, total return year to date is 6.8%. Doesn't seem like the high yield market's too concerned about a recession. How do you guys think about the high yield space?
So I think the high yield has been very, very compelling here for the first time in a number of years. You're still north of 8. 3 or 4 months ago, you were closer to a 9. And if you believed in the soft landing and that there wouldn't be real pressure on credits here, that is a great carry trade. And I think it still does. And the total return numbers are pretty impressive. But again, from a valuation standpoint, you're talking about spreads inside of 400. So again, I think the soft landing is priced into a number of markets, but the income generation of 8 and 8.25 is reasonably appealing.
It's interesting because Gina Martin Adams at Bloomberg Intelligence, she takes a close look at when you're looking at S&P 500 EPS growth, but on a year-over-year basis, but excluding energy, if you look at the most recent quarter, it actually was marginally higher, and then we see that growth back to return even close to double digits toward the end of this year in the fourth quarter. And I know you were saying you're waiting for earnings to bottom. Do you think that when you're looking at energy, is it masking some of the benefits that we're seeing in other industries as we see that sector particularly weaken, obviously with that correlation with what we're seeing with inflation ebbing and commodity prices?
That's fair. And I do think we're probably in the process of troughing here, and energy has sort of depressed the overall earnings. But the economy has been above trend for the last 12 months, and I do think it is going to moderate as we go into year end. So there is a slowing of economic activity from an elevated level, and I do think that that evolves over the next 2 quarters to find where we sort of bottom on the economy.
Right. Once we see the repayments resume for federal student loans, I know that the interest just started accruing, but those payments begin again in October. How much does that fit into the consumer spending dynamic as far as potentially weighing on that?
So I do think that consumer spending most likely has peaked, and that our view is that we're starting to see normalization. It has above, I think, a couple of things. One, as you know, excess savings has been very high. Labor markets have been strong. Wage gains have been solid, and there has been a lot of pent-up demand, especially for services coming out of the pandemic. They call it revenge travel, and I think most of that will remain solid, but has been above and is going to moderate. And we're looking at sort of those dynamics returning to sort of 2019 or what we would refer to as normalized levels.
What are you guys penciling in over at Fiduciary Trust about our Federal Reserve? What are they going to do? Are they done? Are they going to hike one more time?
I think they're done. And so markets, as you know, are sort of a coin toss. They're definitely pausing in next month in September, and obviously November is live and sort of data dependent, but markets have it at a 50-50. I would take the under.
What's the top question you actually hear from clients right now?
But the one that you referred to earlier, this is a confusing market and a risk-free rate of 5%. Why would I do anything? And again, sort of the near-term appeal versus long-term opportunity is always the guidance. And there's a persistent negativity. I guess the biggest question over the last 6 months to a year is the perpetual recession question. Yep. When? Again, we had to push back pretty hard that we didn't see it as a 23 development.
And we don't see it, and you go ECFC, right?
The ECFC function, you don't see that, obviously not on an annual basis, but even on a quarterly basis either. It's no longer there.
Yeah, it's been, I guess, most widely telegraphed recession that has yet to occur. Hey, Ron, thanks for coming in. Really appreciate it. Ron Sanchez, he is the EVP and CIO at Fiduciary Trust Company International.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess, Menton, Paul Sweeney live here in our Bloomberg Interactive Broker studio. Let's get a little techie here, a little wonky maybe. We'll talk a little VR. That's virtual reality for those like John Tucker that may not be up on all that tech stuff. We might talk a little Metaverse, and if we're not careful, we might even throw in a little AI. And we can do all of this with Dan O'Brien. He's president of the Americas and general manager for HTC. Hey, Dan, first, just give us an overview of kind of what you guys do at HTC.
Well, one, thanks for having me on. I really appreciate it, Paul and Jess, and it's great to be here. What HTC does is we are a technology company that focuses on a lot of different areas of innovation. You know, a lot of people know us for smartphones for many years. We now have, over the last several years, indexed towards virtual reality or extended reality, and we make products that create solutions for content creators to create content for the metaverse. We have also innovated and created solutions where you can actually stream content for the metaverse over, say, a 5G network. And then we also create these headsets or wearables that you can interact with this data and this content in a very immersive way. So we are a holistic data technology and innovation company that delivers all these different types of solutions for end users.
Your firm did conduct a survey recently about how VR headsets are being used, particularly in healthcare and social assistance organizations. What did you find?
You know, we found that over 90% of healthcare workers and healthcare providers expect to be using this technology in the future for training or for therapeutics. And so it really shows a resounding, endorsement of, hey, this is very effective. We know that can help with our healthcare professionals and training them. We can reduce training costs. We can improve the actual training value. We can actually get better outcomes for our patients with better therapeutics and performance. So overall, it becomes like a cost savings and an efficiency and a performance improvement in healthcare.
So, Dan, one of the things you mentioned the metaverse, and I don't think there is a concise definition of the metaverse. Certainly not among shareholders of Meta, formerly known as Facebook, and that was a problem for the stock last year. To you, right, what is the metaverse?
Well, it's really an extension of what we already do today in our internet today. It's really encompassing how you interact with the data. Think of yourself now as being able to, as if you're wearing a wearable, it might be glasses, it might be VR glasses, it might be AR, augmented reality glasses. You're simply interacting first party with that data and content. I gave an example, a demo last year where we did a training for a knee operation, and we had people that were on iPhones, iPads, a Magic Leap augmented reality glasses headset, a VR headset, and Android phones. And we were all in this one space together, doing this training together. But some people got to be in the space actually hands-on doing the training, while other people were more of an observer. So the metaverse really comes down to this very immersive, environment where you can interact. But it's not going to dismiss all the things that we use today in our everyday life.
Whenever I hear Metaverse, clearly I think of Facebook parent Meta, along with Apple, that are going along and spending a lot of money in this particular corner of the market. Where do you see this headed for these companies as people are trying to kind of vie for different rivalship here as far as where it's headed, and still a lot of uncertainty?
Well, I think, we're all approaching it in different angles. Apple coming in, it's a great endorsement. They have great privacy policies, great data security policies that some of the other competitors do not have. We share those values as well, in that we protect our users' data. We don't use that data to monetize it. So for us, we're bringing solutions and value to the market to actually reduce costs, bring up efficiencies, bring in human performance improvements with training and things of that nature. Apple clearly showing like how expensive this technology really is, and if you're going to enter the market and not lose money on hardware, this is how much it really costs. So now you got to see like a company like HTC, we come in right in the middle. People are getting great innovation for the price and the value. Meta, they're really using a console, model where they're subsidizing that hardware significantly and losing billions of dollars in order to, maintain that market share. But understand, like, that is all out of fear-based, kind of management, and that they're very vulnerable in their current model to Apple and to, Google and Android on the smartphone business to their revenue model. And they're trying to, I think, make themselves agnostic or, bolster against that vulnerability against those platforms and have more of their own position. And so I think they're trying to buy their way out of that problem.
Dan, when you think ahead over the next several years and you think about the VR business, the wearables business, how do you kind of think about it in consumer use versus maybe business / corporate use?
Well, I think on the consumer side, Meta is kind of settling the market at this very unnatural price point that doesn't really exist. And if you look at it, the smartphone, comparing it to the early days of smartphone, you had probably about 12 to 15 brands and companies, fighting, in the market to grow the market, making a very healthy economy for, competition and supply chain and suppliers, which drove prices down. On the consumer side, it's really being strangled by that pricing tactic. So you're not seeing the competition come in because the other major players don't want to come in and lose their shirt. On the enterprise and professional side, you can actually bring this technology for what it actually costs. And you can bring your companies and your partners and these types of customers massive value where they see the savings right away within that year. In terms of performance, higher retention rates with your training, more engagement. And if you have a diversified employee set that's spread out all over the world or all over the country, you can keep them connected, right, in these metaverse spaces. So this week, I'm at the Industrial Immersive conference down here in Houston, and companies like ExxonMobil, Duke Energy, they've been using this technology since 2016, and they're now looking at all the different ways that they can be using this technology to improve site plans, site designs, working with their engineers in the field and being able to actually see what they're working on, deconstructing, existing platforms that are many, many years old that nobody knows how to work on anymore. So in terms of, growth and enterprise use and major corporations and brands being able to use it, we're seeing it grow very aggressively on the enterprise side.
Hey, Dan, really fascinating discussion. Thanks so much for joining us. Dan O'Brien, he is the president of Americas and a general manager for HTC, talking about the VR space, the wearable space, and then ultimately, presumably, the metaverse.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.